Hey, good morning, options traders. Well, I got a great email from one of the traders in the group recently asking, does ATR, that's Wilder's average true range, show momentum? And his question was along these lines. So if a stock has an ATR of $5, that means that on average it moves $5. And so he was asking, well, if a stock is up, let's say $2 for the day, would it make sense to jump in with a call option since we, in a way, have another $3 worth of expected move? Kind of some gas left in the tank there that could potentially push this stock higher. Because if the average move is 5, we've only moved 2, kind of makes sense that we should jump in there with call options. Well, it's a good question, but does it make sense to do that? Well, to answer the question, we have to first find out what ATR is and how it's calculated, but we also have to understand a very simple mathematical calculation called absolute value. So let's go find out, does ATR show momentum? Well, as always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So let's start off with average true range. What is it? Well, it was developed by J. Wells Wilder in the late 70s. And yes, this is the same J. Wells Wilder who created Relative Strength Index, or RSI. He also created parabolic SAR, stop and reverse. And the average true range is a lower study. And that just simply means that it doesn't sit on top of your candlesticks. It sits down below. Now, Wilder suggested using a 14-period average, but obviously you can change those in your platforms. But for the most part, I would stick with the defaults because that's what most traders are going to use. And the average true range is a measure of volatility. And the reason that he came up with this, Wilder was a futures trader and noticed that there were really big gaps in the market, things that volatility didn't capture, at least in the traditional way that we measure it, which is close to close. So if a stock closes at 100 and the next day gaps up to 105 and falls to 95 and closes at 100, the close to close is going to show there was no volatility, even though that's not true. There was lots of volatility. So he came up with this calculation to include gaps to try to get a better measure of just how much a stock could move. So before we look at the details of that and the calculations, we're going to take a little pit stop here and talk about a mathematical idea, little calculation here that is called the absolute value. And this is going to be critically important for understanding the topic of this video. So in math, whenever we talk about an absolute value, it's just saying how far is some number from zero. So let's say that we have a number line here starting from 0 to +8 and down to -8. And we do a simple calculation. We say, what is 8 minus 3? But we're going to take the absolute value. So 8 minus 3 is +5. The absolute value, these little vertical bars, just say forget about whether it's positive or negative. It's just 5 units from 0. So that would be up here. But we could also flip it. We could say, what's 3 minus 8? Typically, we would say it is -5. But because we have these little vertical bars here, it's telling us to take the absolute value. So what we're saying with absolute value is over here, yeah, it's +5, but we don't really care about that. It's 5 units away from 0. And down here, yeah, it's technically -5, but we're not really worried about that. It's still 5 units away from 0. So whenever we use absolute value, you will always get a positive number. And that's going to be important to remember as we step through this video. Okay, so with that little backdrop out of the way, let's go take a look at true range. What Wilder did is he takes the greatest of 3 calculations. Calculation number 1, you're going to take the current high for the day minus the current low. Calculation number 2, you're going to take the current high minus the previous close, but we're going to take the absolute value. So if today's high is higher than yesterday's close, we're going to get a positive number. But if today's high is below, maybe we gap down, technically you would get a negative number, but Wilder is saying we're going to ignore that. We're going to make it a positive number. All right, calculation number 3, we're going to take the current low and also subtract off the previous close, once again taking the absolute value. So remember, whenever we talk about volatility in the market, volatility is non-directional. It's just saying more about the range of how far the stock could move as opposed to its moving up or down. And that's really what the average true range is doing. It's trying to measure volatility. And then he just simply takes an average of these true ranges. So again, he's calling these the true ranges because it's accounting for gaps. And that's where we get ATR. Now, there's some subtle technicals of here with the smoothing function. I'm not going to go into those, but this is the basic idea. We're going to look at these 3 calculations. Whichever one produces the highest number, that's what we're going to record for that day, and then we're going to take the average of these numbers. So let's see what it looks like visually. Calculation number 1, high minus low. So if we get a green candle, here's the high, here's the low. Notice it's going to be a positive number. If we get a red candle, here's the high, here's the low. We will always have a higher number minus a lower number, so we always get a positive number. So no problems there. But in calculations 2 and 3, that's not necessarily true, and that's why on that previous slide it was showing we have to take the absolute value. So let's say that we see something like this. Here's today's candle in green, here's yesterday's. Now in these examples, I'm going to assume that there's a gap, but the reason he has these second and third calculations is that we could have overlaps, what are called inside days. And so that's where we need to separate these calculations. But I'm just trying to show the basic idea. So today's high is here, and yesterday's close is down here, bottom of the red body. So we're looking at this distance right here. Whatever this high minus this close is would be the number we would get for calculation number 2. But notice in this example, it's a positive number because today's high is higher than yesterday's close. But for calculation 2, we could also get something like this. Maybe we got a gap down. So here's today's high minus yesterday's close. And so now we're looking at this distance in here, but it's a negative number. See, this number here is below this one. So this number minus this would give us a negative number. But again, Wilder is saying don't worry about the negatives. Let's just pretend it's positive by taking the absolute value. All right, so let's look at calculation number 3. Maybe here's today's candle in green, here's yesterday's in red. We're going to take the current low minus yesterday's close. So let's take today's low, subtract off yesterday's close, which again is the bottom of the red candle. We're looking at this distance right here. And again, it is positive because we have a higher number minus a lower number. But we could also get the reverse. We might get something like this. Now we're going to take the current low minus the close from yesterday or the previous close. So now we're looking at this distance here. And so that would give us a negative number. But if you look at the formula, it says don't worry about the negatives. Let's just make them all positive by taking the absolute values. All right, so that's kind of a quick survey of the different calculations. Now, I know it sounds confusing if it's the first time you've ever seen ATR, but it's actually quite simple. Here's a little visual for anybody who might be new to it. Picture a candle, look at high minus low, that's calculation 1, and then take today's high minus the previous close is calculation 2, and then take today's low minus the previous close, and that is calculation 3. So once you have this visual of high and low, you're just simply subtracting off the previous close off of the high and off of the low, and that's giving you the second and third calculations. Okay, so those are the calculations. We come up with a number. So the ATR is actually showing absolute levels. It's not showing us in terms of percentages like it does with volatility. See, when we do a close-to-close volatility calculation, it's showing percentages. So if a stock has 20% volatility, A one standard deviation move would be plus or minus 20%, whatever that stock's price is. But see, we can't do that with ATR because ATR shows the absolute value in dollars. So the main thing to understand is that if you're looking at the ATR for Apple, you can't really compare it to the ATR for NVIDIA and saying that, oh, this one must be greater. It might not really be true because we have to consider the percentages, but ATR does not do that. So another thing to remember is that higher price stocks will have higher ATRs simply because they typically move more. So the main thing to remember is that ATR is not good for comparisons between stocks. Again, don't compare Apple to NVIDIA. You can certainly do it with volatility. If Apple has 20% volatility and NVIDIA has 40% volatility, you can absolutely say that NVIDIA is twice as volatile as Apple. But you can't do that with ATR. And so what we need to do is to look for relative changes. So a lot of times what traders will use ATR for is as a confirming signal with other indicators. But the main thing that we're trying to figure out here in this video, now that you know the calculations, and the real secret is that two of those calculations take the absolute value. We will never get negative numbers, even though they are possibilities. So this whole idea of looking at ATR as a momentum indicator, you got to be really careful about that. So for instance, if a stock has an ATR of $5 and today the stock is up 2, so does that really mean that there's another $3 of upward potential movement? Because again, ATR is telling us that the average stock move is $5. Today it's up 2. So you can see where traders would want to interpret that and say, okay, there's another $3 left in the tank. But now you know how ATR is calculated. It's a volatility measurement. Volatility is non-directional. ATR could be up or down. So if we see a stock that's currently up $2, yeah, if there's an ATR of $5, it's also just as likely that it could fall to -3. So if it falls from $2 to -3, that's still a $5 move in absolute terms. So if you want to use this by itself of saying that you've got some type of momentum indicator, that there's more juice or more gas left in the tank because the stock hasn't used up its full ATR, that's misinterpreting the calculations because Wilder's ATR uses absolute values. And so just because you see that a stock's average move is $5, we have to remember that also includes -$5. So try to get away from the freebies out there in the market, the easy ways of making money by just looking at a calculation like this. They can be great tools, but they are not crystal balls. Trade the market, but hedge your opinion, and the best way to do that is with options. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.